What do you guys want to talk about? What's bugging you? What do you have difficulty with? I can go over the solution from the 1 year if that worked, if that's helpful. If anybody had questions about that. Is there anything that like you want clarity on right out of the gate that we can talk about? Any questions?
Yeah.
Yeah.
For the 1 year?
Yeah.
The tax spending?
Capital expenditures, yep.
Yes. So is that I have seen that you reply to my message.
Yes.
But I'm not totally sure about. Is that different with what the information provided in the PowerPoint? Is that how we do the calculation in real estate?
So your question is, do capital expenditures impact NOI, right? Okay, so let me pull. And there was a point in the PowerPoint you said that discussed that. Do you know exactly where in the PowerPoint that talked about? Because it strikes me as odd that it would be in the PowerPoint because capital expenditures, so capital expenditures do not appear in the income statement. Mm-hmm. They appear in the statement of cash flows because they're not considered like an expense. When you spend money on a CapEx, you're making a large, substantial improvement to the property, and so that gets capitalized, and then what appears on your income statement is depreciation, but not CapEx. So the way it works through like all the statements, so you have income statement, then you have your balance sheet, then you have statement of cash flows. I think you had to do all three of these, right? Okay. So on the income statement, what happens to the balance sheet when you have CapEx is this. So you have property or capital investment, right? Property. Beginning. Then you add CapEx to this, and then you subtract depreciation. And that gets you, this is beginning, this is ending. CapEx then would also occurs in the statement of cash flows here. Because it's cash that you're actually spending on improving the property. Depreciation is just an accounting concept. It's not a cash item, so there's actually not cash coming out of your pocket to pay for depreciation, so it doesn't appear here, but it appears on your income statement. And that's mostly for purposes of calculating your income taxes, because in real estate you're allowed to deduct depreciation against your taxable income, so you reduce your taxable income, and that's the reason like a lot of people want high appreciation to shield their income. So did you find the point in the PowerPoint where he was talking about it? Do you know what slide it was?
It's just like how to calculate the cap rate.
How to calculate the cap rate? Yeah. So because the cap rate is mostly a function of NOI, which is where you're getting to the bottom of your income statement here, and CapEx doesn't go into NOI. The reason being is that when you calculate operating income, you want to think about it in terms of this is the income that is a result of like just normal recurring operating of the property. And like when you do CapEx, it's more of like a one-off, one-time event, right? Because it's like you're making a large improvement to the property. You're not going to do that every year. You're not going to add a new pool every year. You're not going to add a new roof every year. You're not, So it's only, NOI only takes into account what is normal, recurring, everyday items. And so that allows us to say, what does this property generate income-wise on a normal basis? And that's how you, that's how you want to think about NOI over the asset value. Now you're right, like at the end of the, so cap rate, remember, is NOI over total property value. Where CapEx might come into play is this is when you purchase it, but then at sale, so this is year 1, right? When you're selling it, this total property value has been enhanced over the course of those 4 years by the CapEx that you put into it. So this property value is going to, this number here is going to, if you were to, I think what you have to do in your case is you have a net operating income in year 4, and then the cap rate is given to you, right? So you don't really necessarily need to worry about this because you're going to calculate that based on the cap rate that's given to you in the net operating income in year 4. Where I was going with this is saying in year 4, if you hold NOI constant, if this is the same, but your total property value has increased, that would mean your cap rate would be smaller, right? Because this number, if this number increases because you put in CapEx, but you'd also depreciate it. But if this is greater, and this is the same, that means the cap rate would be lower because this number is now the same, but this number is higher. And so when you have a lower cap rate, that just means your property, the earnings are valued at a much higher rate. Right?
Yeah, I just didn't figure out in the first year sheet.
Yeah, where is that?
It's here. It's like there is a hint to how to calculate the cap.
Or just cap rate 6.04. Yep. Okay, so did he provide a solution to this one yet?
Yes. So here is an NOI.
Yep.
And the sales expense is like here. Which is in this.
Yes. Yep.
So when I do the calculation.
Okay. So give me, so what is year 1 NOI?
301,138.
So NOI is 3,301,138.
138.
And purchase price is
44.
54.
54.
Yeah.
540 $.
55,400.
Yeah.
55.
54. 500. 540. Yeah.
Let me see.
Sorry.
It's okay. 54,540. Okay. So what does that straight up give us? That over that. So what are we saying? We're saying 301, 138, 4, 5, 4. Okay, so that gets 6.05. So what he's saying, so we've calculated, let's see this piece first. Okay, so it's year 1, right? So year 1, you have to compare apples to apples. So year 1 NOI is 3,301. In the course from year 0 to year 1, you spent CapEx.
Okay.
You spent CapEx, which is going to improve the property value, right? And CapEx, what's our CapEx assumption? So the CapEx assumption is it's like a per unit basis, right? Okay, additional annual CapEx per unit. Okay, so you have $500 of CapEx per unit times 300 units. Which gives you like 150,000, right, additional value. So this is just value that you capitalize into the overall property value. So now you have 54,540 plus 150. Yeah. Okay.
Sorry, where did the 500 come from?
The 500 is under the assumptions. It's under the category other assumptions, and it's the line that says I-29 annual additional expected annual capex per unit, $500 per unit. That doesn't mean, don't think about that as like saying, oh, we're going to go in every unit, we're going to put $500 of improvements into it. Think about it as there's going to be $150,000 capital expenditure somewhere in this property. We're going to add a new roof. We're going to go in and replace all the windows. We're going to add a pool or something, and then we're going to look at it. We're going to look at this $150,000 on a per unit basis. See how much it costs per unit.
So those are different from the regularly occurring expenses that are above.
Exactly,
Oh.
the maintenance reserve. Yeah. So regularly recurring is like replacing the carpet, or replacing a broken light bulb, or replacing something that's cosmetic in nature, and that's like just kind of like that's happening all the time, and that's considered ongoing and recurring. So you want to include that in NOI, right? You see that occur. You see that in on the income statement, line A9, the maintenance reserve. That's the amount of money you want to set aside for just like ongoing light cosmetic improvements. So that number is baked into NOI. Does that make sense?
Yeah.
Yeah. So instead of looking at year 0, you're looking at year 1, and you have to take this is purchase price at year 0. You have to add what you improve to it to get the new year 1 value, and you have to. So when you're comparing year 1 income to year 1 value, that gets you your year 1 cap rate of 6.04. So everything has to just be year 1, year 1, year 1. Did anybody have trouble getting the same numbers on the income statement that Frank got for the solution? Does everybody understand how the assumptions kind of build up to the different line items, and then how those assumptions will then in turn like inform your revenue, your operating expenses that get you all the way down to NOI? So did everybody get to like NOI? You agreed with that? Okay.
Will it go over the cash flow method?
Yeah. Do you want to go through it line by line?
I just don't know some adjustments. What do you subtract or what add? I don't know.
Which adjustments?
Yeah, it's this part.
Okay. We can go over that. So you understand income statement, get down to NOI. We're cool with that, the 301. Okay. Okay. I'm going to try and get up on the, I think it'll be helpful if I put it on the. And all this analysis was supposed to be no taxes included, right? We're not. Okay. Okay. Net operating income. Okay. So this is the reconciliation between income and cash flow. So income includes some items that are not cash. They're just accounting items. And one of those, the key one to take into account here, is depreciation. So depreciation, does everybody understand like the basic concept underlying depreciation? So like over time, as you have an asset, your property, it will every year you're allowed to depreciate it based on a useful life, and so it gets a little bit less valuable year after year after year. So in this case, we have a 30-year useful life on the property. So over the course of 30 years, that asset will be reduced in value down to zero on a straight line basis, same amount of depreciation every year, 30 years. But that is just that's not like cash is coming out of our bank account to pay for that. It's just an accounting concept. So while we reduced, we included depreciation as an expense up here. It's necessary to add it back. So before we go there, we have a few more adjustments. So below the line, below NOI, we have interest expense, which is a cash expense. This is cash that's coming out of our pocket to pay for the loan that we took on to purchase the property. And we have interest expense of $1.93440 million. 1.96344. That's a negative adjustment.
Yeah. And for the year 2, the interest expense is like the total debt minus the year 1 and then.
You mean the interest rate that's applicable?
Yeah.
It should be the rest.
Yeah, we can go over the debt schedule next. I just want to make sure you understand like how to reconcile, how do you go from NOI to cash. So this is a cash expense, cash. Okay, then we take out depreciation. This is non-cash. And depreciation, 1,829. So we have net income before tax. Just summing up all these. So we actually have negative net income before tax, which means that when you have negative net income, that means there's nothing to tax. So taxes are going to be 0 in this case. So net income after tax is just going to be the same as net income before tax. So these are adjustments to net income after tax now. So depreciation, this is non-cash. We're going to add it back. However, CapEx is cash expense. That comes out of our pockets when we pay for any substantial improvements to the property. And we said earlier that CapEx was 300 units times $500 per unit of CapEx. This is going to be a negative adjustment. So we're adding back depreciation. We're subtracting CapEx. This is a cash item that is not accounted for in NOI. Additionally, we have debt amortization. So this is different than interest expense. So interest expense is the amount of interest that you pay on your loan. In this case, I think what's our loan terms here? We say that the interest rate is 6%. So that means if you have a $100 loan every year, you're paying 6%, you're paying $6 on that loan. But then, in order to, there's a difference between the interest and the principal paydown. The principal paydown actually reduces the amount of your loan. So, just taking this simple example, say our loan is $100 and our interest is